Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just after 11 on October 25th, and we're now joined by Brynne Kelly and Mike Korn. They're going to be discussing all things energy, going over the natural gas report and a lot more. So I'll let Brynne and Mike take it from there.
Hey, everyone. Good to be back. We missed you last week, but Mike and I are back in the saddle again this week and ready to talk inventory numbers and maybe some opportunities that we're seeing in the natural gas market, or at least how to think through some of them with winter coming up and volatility so high. So welcome, Mike. Good to be back with you.
Same. Good morning, everybody.
Excellent. All right. So we have the inventory numbers. It came out, depending on how you look at it, the market was expecting 53. At first glance, when you look at the report, it looked like it was either 58 or 63. There was an accounting adjustment that, adjusted 5 BCF in non-salt storage and had a 5 BCF impact on it. And so people get confused when they first see an adjustment and it takes a moment to absorb it in. But really, at the end of the day, storage levels are where they're at, regardless if we got there via an accounting adjustment or actual flows. That we're still just below 3.1 BCF. We still are injecting, just on an absolute basis, below 5-year average injection levels for this week and the last few weeks. That's not, of course, accounting for weather adjusted and all of that. But anyway, at the end of the day, we put in 58. We're a little under 3.1 BCF. We've got 2 weeks to go, 28 weeks down, and we'll probably end up somewhere around 3.2 something, by the end of this season. So same picture, same story. Nothing's changed. We're still below the average. And I actually think we haven't really been this low since 2005, I think was the last statistic I saw. And the problem with those, going back that far is it's just so hard to do like comparisons to 13 years ago. The market structure has changed so much in how we produce gas, where we produce it, where molecules are flowing into and out of. So I'd be careful looking at some of those, taking that as maybe an analog for how prices might move. It's just a different story. So breaking the inventory levels down by region, we're still behind just about everywhere, actually still everywhere. I thought Mountain had popped up a little bit, but I guess not. And we break that even down further into kind of how much has been injected by region. And you can still see that the laggard is our salt storage area. However, from a relative perspective, the size of salt storage versus total East storage capacity or total Midwest storage capacity, it really is sort of a fraction, but it is where people focus, in that it's almost like looking at Cushing inventories separate from the pads 1 through 5 crude oil inventory levels. It's kind of the barometer of the hub. And so people take their cues off of that. And that's where we're really behind. There's a lot of talk out in the market, and I don't know, Mike, you've probably heard some of this, that the storage is now, especially some of the salt storage, is in the hands of different players, and they're just using it differently than they have in other years, meaning it's owned more by LNG operators who aren't as concerned with summer versus winter cycles. They're focused more on, their individual export cycle, and they're using storage in that way. And so it would make sense that they're not really trying to build up inventories for the winter, since their sales of their gas via LNG are essentially index sales, and they float against NYMEX. It's just purely a formula, those LNG contracts. It's NYMEX times 115% plus a tolling fee. So you can see where they're not really, if that's the theory, and that's the difference that we're going to point to, that we're not, you wouldn't expect to see that inventory build in the summer and draw in the winter. It's cycling all the time, and we certainly have seen that this year.
That dovetails with my clients, some of the producer types out there who for many years really don't hedge the winter or summer, but rather will look at a 6-month strip or a Cal 19.
Interesting.
Yeah.
Yeah, and not go much further out than that, right?
Right. Well, actually, some people will go much farther. I was talking to you earlier today, and yesterday there was a 2026 Cal year that traded. But generally, my clients, look 6, 12 to 18 months out. And
are there a lot of market makers out that far, or is there a handful of players?
No. There are a couple of banks. There are a couple of Chicago market makers, but I think part of the reason is to tie up capital for so long, or if you do a 2026, what are you going to lay that off against?
Right, right. Because there's probably not going to be a lot of volatility back in that strip. So either you just want some length in your book, or short, either way, right? So that you can trade more volume up front. I know when I ran books on different energy desks, in a lot of ways you had kind of total portfolio volume limits, as well as VAR limits, but these volume limits, led you to do some crazy things, right? Just to get the net volume down. If I wanted to go longer in the front, I would sell a bunch more of the back. And until VAR really picked that up, you were okay.
Yeah. By the way, just want to point out with the 2026 trading yesterday, that was under $3 per MMBTU. I think it was $2.94 or $2.96, I forget, but it was right in that area.
Man, so even out that far, we just cannot get the calendar strips to pop their heads above $3.
Right.
Yeah, I mean, what's 19 is 260, 280 maybe, and 20 is 260. Yeah, it's crazy. At least I guess that's not in contango anymore when you get out that far.
Yeah.
So yeah, that's crazy. Well, that's interesting that there's even some activity back there. And I'd imagine that's fewer and far between than it used to be, that there's less people with an axe to grind.
Mm. By the way, are you surprised that after the number and after that dip, we've come back this strong, especially in the very front months? Oh, you just put up another chart. Please continue.
Oh, no, that's okay. Yeah, no, I mean, I love the question. I'm not, just as much as I could, we're getting near expiration. Options come off Friday, November comes off Monday. And, the market always kind of tries to figure out what it's truing up against. So I could have just as easily not been that surprised about a sell-off, except for the fact that the cash market is really holding its strength this month, and it's kind of thwarting any sell-offs below 315. So yeah, I think initially people, it's always funny to me. I think there's so many of these machines that are programmed to get the number right away and then act, if it's, outside of the parameters of expectations. Mm-hmm. And especially when there's an adjustment that comes through, of course, sell, right, would be it's higher than expectations. The machines fire off sales. And then everybody sits back and kind of, you chuckle, right? And you watch the market do that. And then you can step in. So I'm not, to see that people came in and bought again, especially when Henry Hub cash continues to trade 320 to 330. I'm not surprised.
Mm-hmm.
How about yourself?
To be honest, I've been rather bearish, even in spite of the cash premiums, in spite of the let's wait for that first frost in November. I haven't really liked how the market has traded up at the higher levels. Rallies don't seem to hold that much. But in spite of that, I keep feeling like I'm being thwarted, being somewhat of a bear over here. And
yeah, well, we do have first of month index pricing coming up, right? So I would imagine that, there would be an axe to grind to get that price to, as low as possible. So that first of month Platts index is set at a low price. And watch out for that over the next few days. People who trade the gas daily versus first of month index futures, right? You kind of want that if you're going long, right? The gas daily, you want that monthly index set pretty low. So yeah, we'll see. I don't know. Maybe by Friday we'll have some weekend cash weakness again. That always seems to be when futures are able to sell off, is when the weekend package gets pretty low, and you add that Saturday Sunday in there and it kind of blends and drags that down, although they've even had a difficult time doing that this month. So so just to kind of wrap up and kind of move on past inventories, I just wanted to take a quick look at end of season projected levels at around 3.2, and the never moving kind of esoteric end of the winter season storage futures around 1440. I would imply that we would draw 1750 this winter. And you can take that for what it is, right? It looks rather low relative to prior years, even milder winters on what we've drawn. However, there is this overarching Northeast ramp up in production that just continues. And so I think we've moved up over 2 BCF a day in the last 2 months in the Northeast. And so to the extent that you take that over, a few months, the 5 months of winter, and certainly that could make the actual withdrawal look a lot less. I don't know though. I mean, that's Northeast production and it's much more prone to freeze-offs. So it's hard to expect this rate of production to continue, once we have inclement weather. All right. And I guess maybe I even just mentioned that, but I thought some notable themes, Mike, you and I could talk about today is, and I just mentioned, we've got this overarching kind of production growth that continues to ramp up, especially in the last 2 months, the majority of it coming out of the Marcellus region. So that's sort of hanging on the market, right, as a reason to not buy. Add to that we've prior, this summer, there was an expectation that we maybe had about 11 LNG projects that had targeted in-service dates of the first quarter of 2019. And slowly those have all been pushed back to now we're down to 2. It looks like that we might get completed and up and running in the first quarter. So you kind of have this increase in production, and then, you have this delay of expected demand. And yet layer on top of that so far this month, October cash has averaged 325, which is pretty strong relative to how we've looked this entire year. But for January, we haven't been able to see $3. And then how all of that plays on the spreads. So I think I'll even go past cash. I think, Mike, and you and I have talked about this, and I kind of want to kind of ferret it out a little bit. of course, everybody wants to focus on outright price and is getting frustrated that's maybe not indicative of their sense of what our storage situation is. But what I found really interesting as I've kind of been looking at some of these spreads, trading in and out of them, they seem so not intuitive to me, the levels where they're at. And I started to kind of put a bunch of the different ones together. And by winter spreads, I'm talking about November versus March, or December versus March, November versus February. And that actually kind of stunned me, that to see how outside of range all of these spreads are. And really, that's where I think the bull sentiment is really being played out. And I just am going to scroll through them really quickly, and then let's talk. There's the November Feb spread. We're at levels right now that we've not seen in at least the last 6 years. The DC March spread, again, you can see I have all the prior year kind of trend of the spread, and then at expiration. And we're up 25, I think, cents this morning, and have been as high as 31 cents. And you can see that the market is trying to express its bullish sentiment through these spreads, which is why they look like such outliers. So I think we talked last time, Mike, about I'd expect the market to run more towards the end of winter and want to place some length there. And really the market is placing its length in the front.
Yeah, it's interesting because I know you've been tracking the DC March, and a couple of weeks back it was at DC 30 cents over March, and that premium began to shrink. I think it got into maybe 18 cents DC over. And that's when I started thinking, okay, we're definitely going lower. That spread's coming back down to something that makes a lot of sense, that's intuitive. And here we are, it's rallying back. And that makes me think that this is a signal that the market's perhaps stronger than I expect it to be. But that these March beginning to blow back out, not to the levels we saw before, but getting there. Still, 27 cents DC over March.
Well, and the thing is, that's DC over March. And what I've noticed this week, and what day is it? Thursday. Yeah. And the last couple days at least, is that you'd expect when Novi and D's kind of start selling off that spread would come back in. And actually it's doing the opposite the last few days. I mean, those spreads are starting to assert themselves. And, you saw a lot of Q1 selling yesterday, much more so than November and December. And it's almost as if that was driving the spreads out, not outright strength in the front. So it's very interesting. I mean, the winter strip is what, 330, 335?
Hang on, I don't think it was that high. Let me just double check. Hang on a sec. The winter strip 320 and a half bid at 321 for winter, right? Is that what you asked? March 8th. Yeah. Novi 8, March 9. Right. 320 and a half bid.
So I'm trying to think about, how to play this winter strip. I look at volatility, and DC through March, implied vol is 44 to 48%. So expensive.
Yeah. And there's a good chance of even getting more expensive. Oh,
for sure. Yeah. For sure. I easily above 50%.
Yeah.
And so I guess if you just want to, play that, that's one way to do it. It's
Oh.
just hard to expect the price moves to get many of your options in the money, especially when you're paying that much in implied volatility. So I think that's why the market has gravitated towards these spreads. And, I certainly have traded this way and have worked with a lot of people who have, where instead of buying an option, I'll buy December, sell March, and essentially consider myself long a December call, right? For cheaper than it would cost me to go out in the market and actually buy a December at the money call.
Mm-hmm. And
when, especially as implied volatility blows out, you tend to see some of that. Although I'd say the DC March is getting pretty expensive. You probably could buy at the money December call cheaper at this point, or in the ballpark. What is a 325 call? 18 cents?
In these?
Yeah.
These 325s, right. Yeah, theoretically right at 18 cents.
Yeah. And the DC March is 25 cents ish, give or take. So to me, usually I like those spreads when they're cheaper than the options. And I mean, I know I get it. Certainly it's not an option, and there's a lot of other things that could go wrong in that case. But, when I'm evaluating it, and this is even exceeding, that rationality. So, and I don't like that spread just as a spread, to just think about December having so much value, being so much more valuable than March on the storage story alone, right? If it's on the storage story per se, I want March where things are getting a little more scarce towards the end of the season. But so you kind of look at, so you have Jan over Feb by 9 cents maybe. Then you have
a quick question. I don't have a chart historically on Jan Feb, but I just can't remember when Jan was over Feb this much. Even last year coming into this time, I really remember Feb blowing out over March, because that to me was a little bit exceptional. If there's such a thing as a little bit exceptional.
And that's a great point, Mike, because you're right. In years past, the market has, tended to move the winter premium to February over January.
Yeah.
Yeah. So, but
is that
January and by Feb, the way that the front of the market has been so crazy. So you try to think about how to construct one of, a spread in a way that maybe gives you some exposure. And I think you have to put something together in Jan, Feb, March.
Agree, as a butterfly, right?
Yeah.
Okay. I agree, especially in this case, whatever your view of the market is, there's enough volatility in the underlying market that you can definitely capitalize on a butterfly. There should be enough movement, Jan, Feb versus the Feb, March spreads. So the vol situation is good for a butterfly in the futures.
Yeah. And what's so interesting is, you always have great ideas and you start thinking through strategically how to place your bets in this market. Yeah. And the chart I have up now is looking at that fly historically and then where it is now.
Look at that.
And, we're not the only ones.
Right. Okay. So
look at that, right?
Yeah. You look at that and go, okay, that's a sale. I'm just like, just looking at that. But again, what makes me concerned about selling that fly
is too early.
It's too early, but also just getting back to DC March, seeing it getting out to DC 30 cents over, then coming back down, which made a lot of sense to me, but now working its way back up. That working its way back up makes me think that there's something going on. Maybe it's all cash, or maybe there's a structural change in the market going on that kind of makes me want to shy away from selling that fly. But I think the way to come into the market is through the butterfly. I just don't know if this.
Yeah, I don't mind it
buy or
at
sell the
levels just based on the trend. You know, I mean that seems to be where the market is placing its bet. And the kind of one of the reasons I wanted to talk about this is generally March, April has been the spread that is the bull bear indicator. You know, as you kind of move your way through winter, people express their bullish sentiment by buying March, April, and vice versa. And it really is kind of gone by the wayside, that spread this year, right? I mean, it's 20, 30 cents, 28, 30 cents. Probably will, come into flat at expiration as it has in the past. It's just, there's nothing there on it.
Right.
Nobody has any interest in March. As we've talked about, people are selling March against everything. And I feel completely the opposite on that. Yeah. So yeah, I think some of these flies and maybe even the Jan Feb might be the new March, April this year. I like, buy Jan, sell 2 Feb, buy March. I don't love being long the Jan Feb spread at 9, but I feel better about it by being short the Feb March at like 23 cents. It kind of offsets itself a little bit, right? And
that gives you the leg you want to be long, is the contract month you've been thinking about to be long, which is the March.
Right. Yeah. I mean, certainly, the risk, I guess, is February flips to over Jan. There's a lot of time, though, before that will happen. And to be honest with you, the market has not, that has not been the trend. The market is firmly digging its heels in, preferring the very prompt contracts.
Right.
So I think there definitely could be, you get November off the board. December is the prompt contract. January, you're now looking at some real significant basis spreads, especially to the Northeast. And so I think you could easily see January run, and the surpriser would be March finally catching a bid.
And with the fly, with the Jan, Feb, March fly, what I like about it is your time horizon doesn't have to be, I'm going to keep this on for a couple of months. There's enough volatility and I believe enough liquidity to trade in and out of that.
Yeah, absolutely. Great point. All right. Well, I know Mike told us 30, 35 minutes, so that goes by quickly. Surprisingly.
I don't want to stop. No, I appreciate the conversation and our discussion.
Yeah. So anyway, we'll be back every week and hopefully more than that. And anybody, please send, if there's a topic you guys want Mike and I to ferret out a little bit. We're just trying to walk our way through these markets. And especially as we're coming into winter, try to think about what are some good ways to position yourself going into it that maybe aren't so reliant on these crazy options and their insane volatility. I mean, I know everybody's talking about the VIX having moved higher, but what is it, 20-some%? And we're sitting over here at almost 50% in natural gas.
Yeah, an example of that would be the March $4 calls at 9.5 cents, being that far, being $1 out of the money, even though there's time. That's a lot of premium to pay for that out of the money option.
For sure. And I think you could get a lot more movement on one of these spreads, 9 cents. We're not even looking at that for this fly, right?
But that will react. And you can navigate through that, every several.
Yeah, there's more liquidity than there is in any of these options. So if you're looking, for something to trade around or have, get something on your books, take a look at these inter-month winter spreads and Mike and I will continue to do so, and hopefully we can find and land on the right positioning for as we kind of get November off the board, and we see if the market's really going, to hold on to to these spreads at that expiration and going forward. So, all
Generates-
right, thanks everybody. Good to talk to you again, Mike. I'm glad we're back. And again,
Thanks,
send
Brynne.
any questions or topics you want us to talk about, and we'll continue to ferret everything out. Thanks.